You're back. Welcome.
I'm back. Rodeo number 2. It's good to be back.
Yeah. You didn't do that bad last time, so I thought it would work.
Yeah, no, it was a lot of fun. So I'm glad to be here and excited about some of the content and some of the things we're going to walk through, folks here, and kind of take a look back a little bit, but also kind of look forward ahead and discuss some things that are important. And obviously, there's a lot of concern, rightly so, a lot of things happening in such a short amount of time in the last couple of years and even the last few months. So I think this is important in a lot of ways, and I'm just glad to be a part of it.
Absolutely. So as Eddie said, we're going to walk through quite a few things. I've got a lot of charts. Eddie thinks I have too much. So just, settle in, be ready for a little bit longer. But there's a lot that's happened so far this year in the markets and more importantly, kind of looking ahead. What we want to do, we kind of have 3 things for today. So the first one, we're just going to walk through what's happened year to date. Where are we? What do things look like? Number 2, how did we get here? And Eddie's going to walk through some stuff on that front. And then kind of the last and maybe most important is, what do we do from here? What are the headlines that are going to be out 6 months from now? And what do we do as investors to kind of survive and weather through the storms that the markets are so far this year? So with that, let's jump right in to some charts.
Yeah, good. Yeah. So, obviously it's good to look ahead, but sometimes it's good to know kind of how you got to where you are and to position yourself for that. So just kind of looking back a little bit, obviously we know a lot of the structural things we've seen happen because of COVID back in the beginning of 2020. I think sometimes time goes, we had such a traumatic event with that, to think like the whole global economy was literally shut down because of this. It's just unbelievable if you take a step back, but we've kind of come out of it. Fortunately, here in America, we had some vaccines to help with some of that stuff, and you kind of go through and you forget that's where things started. But if you look at that, the economy completely shut down. The Fed and the government was in kind of almost an impossible position. They decided to have some stimulus packages, some quantitative easing, a lot of things that happened in a very short amount of time. We have a chart up to talk about the money supply, how much money was introduced into the system. And Ben, if you can put that chart up so we can show folks kind of the illustration of that. And this is important. One of the best ways I've heard this described recently is if you think about your local city, and if you put a big dome over it and nothing can come in, nothing can come out, and overnight you just double the amount of money inside that city. The price of a good is $1. When you wake up the next morning, the likelihood of that price being $1 is not going to be the same. It's going to be somewhere between $1 and $2. And here you can see in April of 2020, we had a relatively stable money supply, and all of a sudden that number just jumped up because of the fear of COVID. And again, some of those things were very rational. It was a very fear-induced time. We didn't know what was going to happen, and the government had to make some decisions, which they made. That stimulus kept up. You've had a additional stimulus that happened. All in, you had $5.2 trillion that went to businesses, to individuals. We'll have a chart. We'll kind of have a breakdown of what that is. And then you had a whole year where things were just shut down. There wasn't a lot happening, unemployment. And then things started to kind of open up last year a little bit. But before we go that, Ben, if we can pull up that other chart relative to the illustration of where some of this money has gone to, where the government has
here you
introduced. Go. Okay, so you can see, $5.2 trillion in a very short amount of time. And again, I look back, and if you look, I remember back in 2008 when we had the great financial crisis. President Bush was in office. I was in politics at the time, and I remember at the time they introduced a $7 billion packaged. And I remember at the time it was unheard of how people were like, I can't believe the government's doing this. And that was just an introduction of things. And now is, we're talking about trillions of dollars. $1 trillion of this recent stimulus money went to individuals. Those are the stimulus payments of $1,400 and so on, and children, the child tax credit. A lot of those things did a lot of good. But here you can see there was a lot of other things that were allocated for this capital: unemployment benefits, vaccines, again, which were very instrumental and helpful, schools, businesses, and that's just a significant amount of money. I mean, to think about $5.2 trillion in 2 years, it's really hard to grasp. But you look at that, and we talked to folks last year about the reflation trade, where things would open up, money would start getting into the system, and you really saw a lot of things happen. GDP spiked. There was promise. People were actually excited about, okay, we're kind of finally put the COVID behind us. And then you get to the beginning of this year, and then you have the Ukraine-Russia war invasion that happened. And that was obviously a significant event from a lot of geopolitical things, whether it's fuel, something you're going to talk about a little bit later is fertilizer and commodity prices and all those sorts of things. And every progress that seemed like we made in 2021 seemed to be just completely stunted when this war happened. So no one in 100 years lived through a pandemic like we have. And now you have the significance of this war. So a lot has happened to bring us here. And a lot of money. I think the money supply is a big issue because all you hear now is inflation and too many dollars chasing too few goods. We've got a chart we're going to talk about a little bit here later, but you also have a few other things, Ben, I think are important for the folks listening to know as well.
Absolutely.
Those.
Yeah, I mean, I think, and before we jump there, you said something before we started recording too about our 5 economic scenarios we talked about last year, and one of them was reflation, and you brought that up, but also the MMT side and how we said at that time that the policies of pursuing MMT, which is just essentially the government can print its way out of problems, that would become that could become an inflationary situation, because the longer we pursue that, the more likely it is that if it doesn't work out, we have inflation. And only one half of that MMT, modern monetary theory, has been tried, the one half of spending. The part of pulling back the reins and increasing taxes when inflation shows up and significantly increasing rates, that politically is very difficult to do. And we're not really trying that here. Yeah. And so if that's the case, that kind of leads to all this kind of perfect storm in a way of higher inflation, plus, as we're going to talk about, and you alluded to it a little bit, some supply chain issues, that it's not just the money side, but also the supply side, that you don't have nearly as much goods as the demand can fill the demand. So with that, let me share let's look in at the actual investment markets. Now that Eddie set the stage of how we got to where we are, and with inflation and everything. Inflation, the most recent print is crazy high. What is it? 8-9%. And so with that, that's been an impact in the markets. Interest rates have started to go up. We're going to talk about all that today. Yeah. So let me share our next little chart. So this is year to date. If you've seen any of our videos, we like our Y charts that give us all different markets. So this is looking at what anyone can go and invest. This is a good proxy of, if you just invested in low cost index funds, what could you buy? This is, I'll just quickly go through. The best performer year to date is gold. Gold up 3.5%. Then we have bonds are down 10%, and we're going to talk about that. But bonds being down 10% is something no one has experienced as investors. We've been in a bond bull market for 40 years. Down 10% in one quarter is crazy, and we'll talk about that. Then we have emerging markets down 12. Same with developed international markets. Then we have the total US stock market is down 14%. And the worst performer so far this year, down 21%, is the NASDAQ. Those are primarily growth tech stocks. You can think of companies that did really well during the pandemic. Zoom is one that comes to mind. Yep. That did really, really well. Everyone jumped on Zoom. We're recording this on Zoom, but didn't actually play out here so far this year as things have opened up and maybe got a little ahead of itself. If we expand that out further, though, those exact same areas you can invest in, this is looking over the last 3 years. So this includes the entire drop in the market that we had before, and then all in the pandemic, and then so far this year. And even with all that, everything that we invest in is up. Mm-hmm. Bonds are basically flat. They're up 0.74% when you include interest. The NASDAQ, which is the worst in the year to date, is still up 72% over that period of time. And then you've got total stock market, and gold up about the same, about 44%. International has been the biggest laggard that we have there, up only 16% and 9% for emerging markets. But through this whole time period, everything that we own for clients is up and has made money, even with this fall so far year to date. Does anything jump out to you as you kind of look at this?
Yeah, no, I think these two charts are important because it's two essential concepts in portfolio management and investing. And this is not original to me, but Benjamin Graham, in a book, his classic book, Intelligent Investor, he talks about the concept of protection, but also projection. And the first chart, we see the decrease that we're not accustomed to because of the incredible bull market we've had over the last decade. But we're seeing 12-13% S&P, NASDAQ 20%, and you start seeing those losses, and then the natural inclination is the protection aspect, and that's key because you want, we're thinking for the long term, but we also, the aspect of losing money, we none of us like to do that. But the also important aspect of it, which is the kind of the balancing act, is the projection of it. We're investing for the long term, and there is some growth that we have to have. And even more importantly now, with the inflation that we are experiencing, the cost of living and the cost of goods, of everything going up, those two things are very important. So taking a step back and outside of the news cycle, obviously we know where we are right now, but looking back at the historical returns, there is a level of projection that's going to be. Estimates are all over the place in terms of what the next 3 to 5 years are going to be. We have a realistic expectation that we're not going to see similar returns, but we still think there's good opportunities there. Mm-hmm. But the balancing of that protection of the portfolio and the assets as far as the protection is key. So looking at those two is kind of something that sticks out to me.
I think it's really important, and we'll reinforce it as we go through, of course. But, I've said it before, probably on one of these videos. I said it to a lot of clients. Our first step is to say, okay, whatever cash you need from your portfolio, whether it's you're retired, taking money out, you're going to buy a house, whatever the withdrawals that you need, whatever you need over the next 10 years, we don't want to be invested in things that are going to lose money. Yep. And even though bonds are down so far this year, if you have individual bonds and you hold them to maturity, you're not actually going to lose that money. It's going to pay out. You're going to get your principal back. And so we start with let's take off the table the short-term thinking of I need this money to do something today. And so if we can hedge and say now we can invest for at least 10 years for anything that's in a growth area, who cares about 1 month or 1 quarter or even 1 year where you lose money in stocks, as long as you can stay invested and at the end of that 10-year time period you make money, you're going to be fine. And we believe that every single investment that our clients own today will make money in the long run. Absolutely. I can't tell you when, but we believe that everything is going to make money over the long run, or you wouldn't own it.
Sure.
There'd be no reason to own it because we're not short-term traders.
That's true. And again, we repeat this a lot, and sometimes, repetition and, it has it gets dull after a while, but the long-term aspect of it is incredibly important because there's folks that we encounter sometimes, and even family members that I know who say, I wish I would have saved more and invested more at a later time. And some of these have gone through some of the things that, the stagflation periods of the early 70s, and you hear that, and I think that's important because right now we don't feel like it's it's too risky, and there is risk involved. I'm not saying there isn't, but again, having a long-term aspect of it, because the projection of it is so important to one's well-being, financial well-being. And again, this is a portion of a portfolio. It's part of comprehensive financial planning that we do, and it's a big part of it. But there are other things that, kind of you alluded to, is making sure that you have cash accessible for other things, goals and aspirations that you have, which is what we do a lot as well. And we don't see it as much because it's not the most sentimental thing, but it's also critically important when we're working with folks.
Absolutely. No one likes cash until you need it.
That's right.
So
That's right.
Let's shift a little bit and talk specifically about the bond market, because that's been, I think, the biggest surprise for a lot of our clients, and some of the questions we've gotten so far this year is, I thought bonds were safe. Why are they down? Why are we down 10% in bonds?
Yeah.
And so first thing I'm going to show is just two different charts here of the rates that we could have bought first, starting in June of last year for bonds. If someone said, here, I've got a couple $100,000 to put in bonds, what would we go out and buy? What was the best thing for us then? And then what does it look like today? And so starting with that, so this is the yields, the rates that we have again, back June 15th, 2022 for that week. And I just want to highlight a few things. So let's focus first on this area here. This is tax-free municipal bonds. We tend to buy intermediate term, and so yield to worst, you could earn 1.1%, that great return back in June of last year. And that is for a 2 to 12 year time period. That is a pretty long term, it's intermediate term here, but pretty long when you think about a lot of us are short-term thinkers naturally. And so 2 to 12 years can be a long time. And so that's tax-free yield of 1.1% or taxable yield of 1.5%. So that's the returns. This is not an inflation adjusted return. This is truly just the safe return you could get in bonds. Okay. What does that look like today? Today, I've got that chart here. That has jumped all the way up to, looking at the exact same two areas, all the way up to 2.85%. The same level of principal risk of what if these bonds don't default, or what happens if they default, the same amount of risk there, 2.85% compared to the 1.1 that we had on the tax-free, and all the way up to 3.5% on a taxable yield. That is a dramatic increase in, 10 months, 11 months. And so if you remember anything from bond math, which if you've been a client for a while, I nerd out on bonds and I could talk about them all day. Interest rates and the price of bonds move inverse of each other. So as these rates have gone up, the price of your existing bonds have dropped. And if we just take a step and say, why does that happen? Let's say you have a bond that was paying 1.1% 10 months ago. Nobody is going to pay you the same amount of money for that bond when they can take the money they gave you, or that you bought it for 10 months ago, and buy it 2.85%, they're not going to pay the same amount. So that price is going to come down because it's just not worth as much, because the market level of interest is a lot higher. We have been selling bonds for clients for a couple of years now. So if you've been with me for a long time, you had a whole lot of bonds. As interest rates fell off a cliff right after the pandemic hit, we started to sell some bonds. We continued to sell bonds, not reinvest. This actually may be one of the first times in a while that we may actually look to buy some bonds. And the biggest reason for this is what's already priced into the market and what's likely to happen. So right now, and we can see this by the bond market right now, there's an expectation of the Fed raising interest rates 10 times between now and February of 23. And so we've got this one more screen here where you can see kind of what the market is pricing in. You can tell at every Fed meeting what's expected because of the way bonds are trading for the different time periods. And so it is assumed that interest rates, the short-term overnight rate, the Fed rate, will be all the way up to 3% likely by February 1st, 2023. That is a dramatic increase from where it was for the last 5 years. Yep. I mean, I don't know when it was 3%. It's been 15 years since that's happened. Yep. This is what the bond market is currently priced as, which means if the Fed raises rates at this rate, we would not expect that bond interest rates as they exist today to move dramatically because it's already priced in. The only way that we move dramatically in interest rates in the market is if this doesn't happen. Either we move faster, the Fed increases rates even more, or what I would say, this is an opinion, from my opinion, probably the more likely scenario is that it doesn't raise nearly this much and this quickly. Eddie, what are your thoughts as you kind of hear all this, all these things?
Yeah, no, it's as you mentioned, just how quickly that rate has changed, and you saw some adjustments because of COVID and the rates and all that, and how things have changed. So this is part of the whole portfolio management. There is an aspect of bonds still having an important function in a well-diversified portfolio. They're not going to be tremendous gainers, but as you mentioned, the amount you pay for a bond when it matures, that principal amount you're going to receive in return. So there's just a lot of moving data. If you take a step back outside of the news cycle and you hear the headlines of Fed raising rates, you have soft landing, can they manage all this? We don't know. We know that there's some things that are already in play and already factored in the market, continually analyzing that regularly. And, within a diversified portfolio for an individual, we're looking at those things and how does that play? And as you mentioned, it may make some sense now to buy some more bonds for some individuals because of some of that change. So it'll be a continual observation, a continual verification that we do in terms of our due diligence, analyzing portfolios. And it's part of what we do on a regular basis. So we know things are changing. We know things have changed tremendously. And in 6 months, they could be a little more different. So this is why we are in this day to day. And it's exciting in a lot of ways, but it's also nerve wracking, especially if, you see a lot of fluctuation and some of the bonds haven't performed their hedge performance as they have historically, because you've had some decreases, but it doesn't mean that that's always going to be the case. So it's just it's one aspect of a bigger pie, and we'll continue to look at that for folks and see what makes sense and what doesn't make sense.
So I have one more bond chart because I can't jump off of it yet because I like bonds, as you know. And so and just speaking to everything that Eddie just said, which part of it is what's happened and how do we get to where we are, which every investor has been investing in a falling rate environment. And so just to quickly talk about, kind of reinforce the last thing I said, which is maybe we're towards the top of interest rates, although we're not going to bet one way or the other, but we also recognize if you can invest at a higher rate, you're going to get higher returns. So the last little chart I have here for bonds is the 10-year Treasury rate. So this is the long-term history of 10-year Treasury. And you can see that peaked in the early 80s. This is 17%, which is crazy. And then, but I want you to notice that as rates have fallen over this period of time, you've had a few different peaks, and every year you seem to have a lower peak as we go down. And so over time, what you actually see is that we have this downward trend in the high point of interest rates after every recession. And it speaks to what Eddie said before, which is, back in '08, 700 billion was a huge number. Now it's 5 trillion is the big number.
Yeah.
Who knows what the next recession, but the playbook this entire time has been to increase spending to come out of every recession. That's basically been the playbook since the 80s. Well, what does that mean? That means there's more debt that's out there. And I don't think it's a coincidence that interest rates have peaked at lower points after every recession, because there's more debt, which means the interest cost is a lot higher for the federal government. Okay, what does that mean for today? That doesn't mean that we're at the peak, but it does suggest there is some sort of trend here that there's only so high that interest rates can go when we just spent $5 trillion.
That's right.
And we've got a whole lot more. And so with all that, again, we're not betting one way or the other. But what I do want to say is the interest rates as we have it today are a lot higher than they were 10 months ago. And that's why your bonds have lost money. But I wouldn't expect another 10, 15, 20% drop going forward. We're going to let the interest pay out, maybe even buy some more bonds. That's a safe part of your portfolio. It still provides principal protection because we still have that maturity date that down the road you're going to get paid. And so just because it hasn't done really well doesn't mean we shouldn't be buying some bonds. We're not going to go back to what it was a few years ago, though, pre-pandemic, of a significant overweight of bonds. That just doesn't make sense where we are either. Although I'm excited about 2.9% compared to where we were in mid 2020, I'm still not that excited about 2.9%.
That's true. Yeah. No, it's a good point and good illustration. Yeah, for sure.
So let's shift to kind of two areas I want to talk about. And Eddie, maybe you can kind of set it up, talk about China first, but areas that maybe aren't the biggest areas of the news yet, but we expect to hear more and more about, and may actually rattle the markets a little bit as we go through. So I'll let you kind of start as I
Yeah. So as you pull those charts out, so I mean, probably heard in the news as well, but I mean, currently China has a zero tolerance COVID policy. So at the hint of any positive tests, very aggressive measures take place. I think the last 3 or 4 weeks, Shanghai has been completely shut down. And that seems kind of foreign to us. And it's like, oh, well, that's just a different government system, however you want to view that. But I mean, you've got a city of 28 million people that are literally shut down. If you look at some of the importance of that city within there, and then you've got also Beijing now, they've got some really restrictive measures. Dining has been shut down, a lot of things. So a lot of goods come out of China, obviously, which is a supply chain issue, which is kind of what you're going to kind of get into here a little bit. So you got that chart up, and I'll let you take it from there, Ben.
Yeah. So as Eddie said, Shanghai is very important, especially with shipping. This is showing you the change from 2005 to now 2021 in terms of the container top 10 container ports. And you can see in the 2021 side, Shanghai's at the top, but almost everything on that list is in China. And so when you have a zero COVID policy that is being pursued, and there's some crazy videos that are out there of what's happening and everything else, that leads to some supply chain issues similar to what we saw during COVID when everything shut down then. And, no one knew anything at that point about COVID at that point, but this is kind of rehashing the exact same situation. And so if you remember, what was that, a year ago, 18 months ago, you probably saw some news about the LA port and how many ships are waiting off there. This is even bigger. What you're looking at here is the ships currently that are waiting outside of China. Essentially, the green dots are on time, currently moving as they're supposed to. And all the other colors are ships that are just waiting for shipping. And I've read as much as 20% of all container ships are sitting outside of Chinese ports right now, just waiting for what they have. Well, if we think back to the last time this happened, that led to shortages on all sorts of goods. We couldn't get what we wanted when we wanted it. You had the toilet paper run, all the other things that happened. And it eventually led to inflation because you have high demand and low supply. And that is something that takes several months, even a year, to feed through the entire system. Where I know there's people that have bought furniture even recently that say, I still can't get furniture. This is before the zero COVID policy in China, that it still was backed up. If you didn't buy what was the floor model, you don't know when you're going to get your furniture. You don't know when you're going to get your appliances. We're not predicting that to happen again. What we are predicting is that this will become a bigger news story over the next several months, that you may even see some goods inflation because of it, and that we just need to be prepared for it, that this can have longer term impacts, and it's okay because we're still long-term investors, that we believe this will all work out eventually, but it may have some disruption in the markets and both goods markets and then investment markets going forward.
Yeah, no, that's good. I mean, and it's, you look at that chart, you're like, oh my goodness. And I mean, I usually not. I mean, we just go to the grocery store, and I think the toilet paper is the first kind of indication we had. I mean, before here in Florida, we've seen it when we had hurricanes, and then just the hint of it. Bottled water, all those things that you think canned goods, batteries would be like completely gone in a heartbeat. Now things are not because it's a run of supply, it's just because you've got some supply chain issues here. And the amount of stuff that's on those ships that feed through the system for all kinds of goods and services is really hard to put your mind around. But we can obviously see that that's a problem, and anticipate that, as you mentioned, is going to have some inputs into feeding some of these things, whether it's cost of goods going up more. Different thoughts if inflation's peaked or not. I suspect we still got some ways to go. And I think we all see it. I mean, every Friday it's Pizza Friday in our household. And we get some Diet Coke. And I remember a week and a half ago, I went, or a week ago, whenever it was, I went and I looked at, I went to Publix here, where their motto is shopping is a pleasure. And I looked at a 12-pack of Diet Coke. It was $7.75. My pleasure of shopping quickly went down. And I was like, in the week before, it was, it was like $1 cheaper or something. And that's the first time I've seen an increase of price in like such a short amount of time.
Yep.
So it's real. I mean, we're not saying it isn't, and we understand that that's a reality. And again, when does China decide that they're gonna, stop and open up some more? We don't know that, but we suspect that this is going to be something folks are going to hear about a little bit more, which is why we wanted to bring it up.
Absolutely. And that leads and great segue into kind of the next one that we want to talk about, which is food inflation. And as we look, the Russia invasion of Ukraine obviously has humanitarian impacts and everything else in the localized areas. At the same time, there are arguably longer term impacts on a couple different fronts. One is on food. And so fertilizer is one key input into global agriculture. And there's been a lot that has been talked about. Ukraine missed its growing season, and Russia with some of the bans that they're not going to produce as much agriculture, and that's going to have direct impacts. But we want to talk today a little bit about fertilizer, because that is something that impacts all of us directly and indirectly on what we pay for food. And so first, let's just see what has actually happened to fertilizer price. So since really the war started, you've seen a huge increase in the price for fertilizer. Why did that happen? Well, that happened because Belarus is the third biggest producer of potash, which is a key input into fertilizer, and Russia's the second biggest. And with the sanctions and everything else that's come out, they're not going to produce fertilizer the inputs for fertilizer to the same rate. which means we have these supply disruptions that will impact the global agriculture um, entire area. And we've already seen it in price that will play out for the rest of this year until next year's growing season. Because these are the inputs that matter as all of the northern hemispheres is planting right now, and that will impact food production, that will impact profits, that will impact the price that comes to you as the consumer that you're going to have to pay. And so we don't believe that food inflation has peaked, because there's a lot of inputs that haven't yet played out in it. That could lead to some negative impacts, not just for you, as you go to the grocery store, but also as you think we're third world countries. And I know Gary has said that famine is a part of every political instability in some way or another. And I think that's a very fair assessment. And so that can lead to some longer term impacts. There's a lot of negativity there. And we're not saying this to scare anybody, but what we are saying is this is something we expect to hear more and more and more about as we go throughout this year. We already have seen some of it, as you said, with your Diet Coke. I don't know that fertilizer had a role in that, but with whatever it looks like, but we expect that to continue.
Yep.
That doesn't mean we need to change what we're doing or change behavior other than, maybe you don't buy as much of something you don't need or anything else. So I guess as you look at that, as we talk through Ukraine, Russia, specific to agriculture, is there anything you want to add on that front, Eddie?
Yeah, no, it's just one of those things that we can see a glimpse of it, kind of looking out. If we had the answer, it would be great, but we don't. And again, this is part of education. We want to make folks aware of some things that we kind of look and we can see on the horizon. And there's some articles that are being published about it, but unfortunately, you don't hear about that stuff until the effects are actually felt. And again, this is part of saying, okay, we suspect that you're going to see some effects and feel some effects of this in the next, 3 to 9 months or so. And it's nothing to be afraid of or fearful of. I mean, it's just sometimes knowing what you're kind of encountering is helpful from a psychological standpoint to prepare for. And there's changes we make, and I know there's some folks that are making all kinds of different adjustments to kind of protect and make some adjustments. And I think the important thing is if I take a step back and you look at this, and it's like we're still like extremely fortunate in so many ways that although some things are difficult, we still got such an abundance of things in front of us that are helpful to us. Still live in the greatest country in the world. Still a lot of opportunity here. A lot of things are going to change. You're going to see a lot of innovation in the future, and it's just a unique time. There's no way around it. I mean, and uniqueness, disruption always causes fear and some anxiety, and that's understandable. The idea is to acknowledge that these things have gotten us here, and then okay, how do we manage this moving forward in a reasonable, responsible way? So
that leads to kind of one area that we do want to talk about from an opportunity perspective that could be out there that we will be talking to clients about. We've already made some changes for some clients and added this to the portfolio, and we think there's some growth opportunity. And so I'm just going to share my screen one last time, and we're talking in the energy space. So this is kind of looking at energy prices over the last, this is as of today, last month, last year. And you can see that over the last year, there's some pretty dramatic increases. Natural gas jumps out at you, and you've seen that if you have natural gas. And there's a lot that's already happened here. But one that we want to highlight specifically is actually uranium. And so as you may or may not have seen, with the push since the Russia invasion of Ukraine, with the push for energy independence that especially Europe does not want to rely on Russia for anything, there's been a complete shift politically in France and Germany and other countries to push for nuclear energy. And it does fit with kind of the green agenda of trying to reduce the fossil fuels. And obviously, nuclear's got its own issues environmentally, but it definitely helps move that direction of getting off fossil fuels. And so kind of fits overall globally. And then even was it last week, California had always planned to shut down a reactor, and they changed their mind. And so with that, we think there's an opportunity here to invest in kind of this future energy that is only going to increase, and that's uranium and nuclear power overall. And so this is just a chart of the last year of what uranium prices have done. This is uranium, I think, by pound, price per pound. And the key here is, it's my understanding that somewhere around $55-$60 per pound is the price level of when uranium miners are profitable. That's the break-even point where it doesn't make sense to reopen a mine and produce uranium unless the price gets above 55, 60. Well, we're at that point. And so there's actually, we think, a good opportunity here, especially because we've had this drop off a little bit, which you've seen in uranium investments, that if we could invest in uranium and uranium mining, that will help impact the inputs as, France is adding, 20 reactors in the next 10 years. There's going to be the demand and there needs to be supply. And this is something we can help invest, make some money, and also help that supply be produced by investing into those areas. So we think this is a good growth area, even with all the uncertainty and everything else that's out there, to have a little bit in the portfolio. There's a lot of negativity, but we still think there's opportunities out there in uraniums in one spot. Eddie, any thoughts?
No, actually, I usually have something to say, but on this one, you did it.
You got nothing.
I have nothing else to add to that, so it's good.
Nothing else.
No.
And it's something we've looked at for a period of time and had some clients invest in, and I think it makes a lot of sense to go down that route again for small pieces in the portfolio. So just to kind of wrap everything up, Eddie did a good job there of just saying there's a lot of bad news and there's a lot of reasons to be pessimistic. But yet, we believe in the innovation. Just think back to some videos Gary and I did a few years ago, right after COVID started and everything shut down. And we talked, and it was the summer of 2020, we talked about the concerns we had of how long it would take to get a COVID vaccine, because there never had been a coronavirus vaccine ever created. And you move forward just a few months after that video, and the first vaccines came out. And they're not the end all be all, but that just shows the innovation that when we are presented with problems, you look historically at any period of time, we figure out a way, and we don't always know the path. We don't always know what's going to happen. And we still believe that everything that you own, every investment is still going to make money in the long run if you stay invested. And we're going to rebalance when things drop in price. We're going to buy more of it. Even though psychologically you don't want to own that anymore. Emerging markets is a good example. Emerging markets, there's a whole lot of headwinds right now. There's a lot of reasons to be concerned about Eastern European markets and Asian and South Africa and all sorts of concerns for all of those, which has led to the price, still being low. And yet we still believe there will be growth. If you look over a long enough period of time, there will be significant growth in all of those areas. And so we want to stay invested and let the money work for you and focus. You should focus on what you can control. So if you're worried about inflation, okay, maybe change what you're spending on, or don't take that trip that you were going to take, or spend a little bit less. That's something you can control. But when it comes to the markets, the biggest thing you can control is to just stay away with your emotions and let your money do its job, which is to work for you and invest in companies that are going to continue to make money and grow and innovate and do better. And that's really, when it comes to investing, that's all we're doing. It's easy to say, oh, I own, a couple shares of a mutual fund, but those represent companies that have people working in them that are producing things and trying to compete and get better and provide services and everything else. We still believe that that's going to be important for a year from now and 5 years from now and 20 years from now.
Yeah. Yep.
So
no, that's good. And listen, I think at the end of the day, we each have our own individual goals, aspirations. I mean, we just had a client who purchased their first home, talked to a client a week and a half ago, and how do we kind of help them and prepare out through investing also, but also purchase their first home. We got some clients who have grandchildren who are graduating here this month. Other clients who have actual daughter that's graduating. There's so much, and I think at the end of the day, the portfolio serves an important foundational function. Going back to the aspect of protection, but also projection, and the projection combined with a comprehensive financial plan is what is it? What does a fulfilled life look like? And there may be some short-term goals that are different, and there's long-term goals, and there'll always be a trade-off. But the end of the day is money is a value. It has a numerical representation, but it also should lead to that aspect of a fulfilled life, to where you sense that your money has achieved something, and there's a sense of fulfillment there. Mm-hmm. And part of what we do is this is an investment video looking at macro items and how we got here, but we're also in terms of being a comprehensive financial planning firm. Having a fulfilled life is an important intangible. You can't put a dollar on it. Right. But it's a goal that we aspire to achieve and help folks too. And what does it mean to be happy? It's going to be different for all of us a little bit, but right. we like to get to that point. So
yep, money is just a tool to help you reach your goals, and everyone's got your own individual things and things that fulfill you, and this is just a tool. That's and that's all it is. So yep. I think that's a great way to end, and I know this is longer than normal, but we've got a lot to talk about. It's been a crazy 2022, and so we're here if you need us. We'll continue to communicate throughout everything, but I more than anything want you to know we're aware of what's happening in the market. That's what we're here for, and making adjustments, but more than anything, still believe in the long-term, power of investing and just stay invested. And that's the number one thing. So anyway, Eddie, great to have you again. I guess we'll maybe bring you back. So
that's great. Well, hope everyone has a great one. All right. Take care.